markets are expecting the Fed meeting this month may be a non-event with no change in interest rates. But should the Fed be worried about a debt bubble in the making? Let's get that question answered from Tom Stringfellow. He is Chief Investment Officer of Frost Investment Advisors, which has over $11 billion in assets under management. Good to see you here, Tom.
Thank you. I appreciate the opportunity.
So where is this potential debt bubble that you're looking at and feeling a bit concerned about?
Yeah, it's a number of items right now. We look at housing pricing at an all-time high. We look at consumer debt moving up to levels that they're not at stratospheric levels that they've been in the past several decades, but they're getting close to those levels. And so when you look at a number of factors that are impacting the housing market, you've got, as I mentioned, housing at moving to all-time highs, but meanwhile you've got home ownership at cyclical lows. And so when you add that to the fact that households are continuing to build up, you look at the fact that you've got first-time home ownership at relatively cyclical lows, and then you look at new home construction is at essentially decade lows. I think 10 years ago you had 5 new housing starts for every 1,000 people. Today there's about 1.8 housing starts for new people. So when I look at a debt level that could become a bubble, what we're doing is looking at and forecasting what could continue happening: low rates, home ownership increasing, housing starts increasing, and then you've got at some point in the future, we know what's going to happen, interest rates are going to move up. So when interest rates start moving up, the affordability of housing starts becoming even more strained. You start getting some inflationary pressure because the housing prices continue to move up because of increasing demand. I mean,
it's a circle, really.
It's a circle.
Yeah.
I mean, there's a hamster starting to turn right now, and the wheel, it's not moving fast, but you can kind of get a sense. It's just like inflation. We know it's out there. We know it's going to happen. We're not so sure the feds are going to prime the pump just right with their rate hikes and their monetary policy. We hope they are. They're telling us that they're going to be very successful at it, but we've never been in this kind of environment.
So from an investor standpoint, because you've raised some interesting issues here, how do you position yourself? Because a lot of times in September, people look at their portfolios and try to make sense between now and the end of the year. What do you do in that environment sector-wise with equities?
And that's a good follow-up question, because candidly, we're in the business to invest money. We invest in equities, we invest in fixed income, and you're always looking at what's going to be moving over the next quarter or year. I mean, ideally, you want to look out over a several-year investing period. But the fact is, you've still got to look where there's momentum and attractive valuations. Housing is nowhere to the level of attractiveness it used to be, but the demand will continue moving things until some of the pieces fall in place that I mentioned, at the point where rates start getting more expensive. One hike I'm not worried about, where all of a sudden investors are starting to fall off, or homeowners are starting to fall off, we get worried. Until then, the housing market is still a good place to look. They'll have attractive valuations in different sectors. The follow through, for consumer discretionary. When a household forms, you have auto purchases. There's been some question whether or not that will continue. You have the truck purchases, you have furniture purchases, you have the higher ticket purchases, all running around the consumer discretionary, which you couple that with new households, new neighborhoods, new services. So, I think there's that same cyclical play that we talked about that's tied to what happens when the bell rings at the height of the housing boom. We still got a ways to go, as we have a ways to go in the consumer discretionary. Rates aren't that burdensome yet, but again, there's going to be a point, because there's an inflationary lining in there that's going to show itself over the next, I don't know if it's a year now, 2, 3, but we shouldn't dismiss it. We need to be aware of it.
All right, Tom Stringfellow, waving the caution flag for us to think about here.
Absolutely.
Thank you. Thank you so much. Appreciate
Absolutely.
it.
Appreciate it.
I'm Rhonda Schaffler for The Street.